Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Moderna.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Okay, so let's just be honest.
Please.
When you say Moderna, most people's brains, they just immediately go to 2021.
Oh, absolutely. Masks, long lines, that little card you had to carry everywhere.
Yeah, exactly. But we're not here for a nostalgia trip, are we?
No, not at all. In fact, if you're looking at Moderna today in, early 2026, and you're still seeing it through that pandemic lens, you are missing the entire point.
The whole story.
The whole story. The company we are analyzing today is trying to do something incredibly difficult. It's pivoting.
A huge pivot. From being the COVID vaccine company to potentially a global leader in personalized oncology.
That is a massive shift. And I think that explains the stock chart, right? It looks like a roller coaster.
I mean, it was down 90% from its peak at one point.
A total collapse. But recently we've seen a pulse, a pretty strong one. So the question we have to answer today is pretty simple. Is this a dead cat bounce, a momentary blip before it crashes again, or is this the real deal, a genuine turnaround?
That's the multi-billion-dollar question, isn't it?
It is.
And the aha moment here, the thing that changes all the math, it isn't another booster shot. It's about the data we just saw this January.
The melanoma data.
The melanoma data.
Yeah.
That single piece of information shifts the entire conversation from, shrinking vaccine demand to what is a personalized cancer treatment platform actually worth?
And we're talking about a huge market.
We are potentially talking about opening the door to a $100 billion market.
$100 billion. Okay, that gets your attention. But let's unpack this properly. Before we get into futuristic cancer cures, we have to look at the checkbook.
Always. The fundamentals.
Right. Because if they run out of cash before they can commercialize this, none of the cool science matters.
Yeah.
So looking at 2025, they reported $1.9 billion in revenue.
Right. And for context, that actually beat their own guidance by about $100 million. So from a pure execution standpoint, they did better than they promised.
That's a good start.
It is.
It's a beat, sure, but let's play devil's advocate. $1.9 billion is, it's a tiny fraction of the $19 billion they were doing at the peak.
Oh yeah, that money's gone.
That money is gone. Now, looking ahead to 2026, they're forecasting 10% revenue growth. My question is this just them crossing their fingers hoping for a bad flu season?
No, and that's a critical point. This forecast isn't built on hope. It's built on signed contracts.
So it's structural revenue.
Exactly.
Yeah.
Yes, you have the repeatable booster market for high-risk seniors. That's a baseline. But the real story is the government partnerships. Look, the UK, Canada, Australia.
The UK deal really stood out to me. Can we dig into that a little?
It's a fascinating model. They're expecting $200 million just from the UK in Q1 2026 alone. But it's not just about buying shots.
It's more strategic.
It's a strategic partnership. The UK government is essentially paying Moderna to be on standby, to have that manufacturing capacity ready to go.
So it's almost like a subscription service for a country's health defense.
That's a perfect way to put it. And that provides a floor for the stock. It's guaranteed cash flow that doesn't depend on how many people walk into a pharmacy.
It stabilizes the ship.
Okay.
So revenue has a floor. But the other side of the equation is spending. And this is where I was surprised. Back in 2024, they were burning through $6.5 billion in operating expenses. For 2026, they're projecting that down to a range of $4.2 to $4.6 billion.
It's a massive cut. You're talking about trimming $2 billion of fat.
But how do you cut $2 billion from a research company without killing the research? Aren't you shooting yourself in the foot?
That's the risk, right. But it looks like they're just getting disciplined. During the pandemic, they had infinite money, so they funded everything.
Right.
Now they're prioritizing. They've cut the nice-to-have projects and doubled down on the need-to-have.
Which is the oncology pipeline.
Exactly. They're streamlining to build a bridge to 2028.
Let's talk about that bridge. In biotech, cash is oxygen. Run out of air halfway across, you're done. How's Moderna's oxygen tank looking?
They're breathing very, very easily right now. They ended 2025 with $8.1 billion in cash and investments.
And with their term loan, total liquidity is what, around $9 billion?
Around $9 billion.
People on Wall Street call this a fortress balance sheet. Why is that such a big deal for the average investor?
Because it means independence. When a biotech company gets low on cash, they get desperate.
They have to dilute shareholders.
They go hat in hand to Wall Street and sell more shares, which makes your slice of the pie smaller. Moderna doesn't have to do that. They can fund these incredibly expensive cancer trials all by themselves.
And they're targeting cash flow break-even by 2028. So the math is they have this $9 billion pile, and they need to make it last for 2 years of cash burn.
That's the timeline. It's a race against the clock. And that brings us to their moat. Why do we think they can actually win? It's not the product anymore, it's the platform, the mRNA technology itself.
We hear platform thrown around constantly in tech. It's such a buzzword. How is a drug company a platform?
So, think of it like a typewriter versus a word processor. Traditional vaccines are typewriters. To change what you're targeting, you have to physically change the machine, grow viruses in eggs.
Takes months or years.
Right. But mRNA is Microsoft Word. It's software. You just type in a new genetic sequence, hit print, and the manufacturing is identical.
The machine doesn't care what code you put in.
Exactly. It allows for incredible speed. The best example is their partnership with Merck on intismeran.
The personalized cancer vaccine.
Right. Merck is a giant. They don't partner with just anyone. They're locked in with Moderna because of that speed to market. Plus, there's a legal moat.
The Arbutus patent win. That sounded like jargon to me. What does it actually mean?
It solidifies their IP protection on the delivery system, the little fatty bubble that carries the mRNA into your cells. It creates really high switching costs.
So a partner like Merck can't just leave.
Not easily. They'd have to start from scratch and navigate a legal minefield. They're essentially married to Moderna at this point.
For better or for worse.
And looking at the data, it seems to be for the better.
All right, let's pivot to the charts. The price action has been wild. It just hit a new 52-week high, touching $46.29.
And context is key. It didn't just drift up. It surged 12% on the projections, then another 15% after the JPM conference.
When you see a huge move like that, you have to check the volume. Was this just a bunch of retail traders getting excited?
No, and that's the confirmation. The volume spiked to over 4 million shares on that high. That tells me this isn't just noise, that's institutional involvement.
Big money moving back in.
Right. And structurally, on the chart, we're seeing higher highs and higher lows.
Okay, for the novices, what does higher highs and higher lows actually signal?
Imagine a staircase. For 3 years, this stock has been walking down the stairs into the basement. Now, for the first time, it's turned around and started walking back up. It signals a psychological shift from sell the rip to buy the dip.
Okay, but I have to play the skeptic again. I'm looking at the RSI, the Relative Strength Index. It hit 74.26.
It's technically overbought.
Very overbought. It means the rubber band is stretched pretty far. Statistically, a short-term pullback is extremely likely. If you're chasing it right here, you might be buying the exact top of this move.
That's a fair warning, a very fair warning. But let's look at the sentiment driving that move. Why is the market ignoring that signal and still buying?
We ran the numbers. The Alpha Vantage sentiment data is pretty overwhelming. 4 out of 5 high-relevance news items are bullish. Weighted sentiment is strongly bullish.
And the engine behind all that is the INT data. That's individualized neoantigen therapy.
Neoantigen. That's a mouthful. Explain it like I'm 5.
Okay. Imagine cancer cells are burglars, but they look exactly like your family, your own cells, just mutated.
So your immune system, the police, just walks right past them.
Exactly. A neoantigen is like a unique tattoo that only the burglar has. It's a mutation specific to that tumor. This vaccine teaches your immune system to look for that specific tattoo and take it out.
It's customized training for your body's defense system.
Precisely.
Sounds incredible in theory, but we've heard about cancer cures for decades. Does it actually work?
Well, the 5-year phase 2b data showed a 49% reduction in recurrence or death for melanoma patients when it's combined with Keytruda.
49%, that's not a rounding error.
It's massive.
Yeah.
In oncology, you fight for single-digit improvements. A 49% reduction is game-changing. It validates the entire technology beyond just infectious diseases.
But this is where it gets weird. We have this incredible data, this bullish sentiment, and yet the Wall Street analysts. The consensus is still reduce?
And the average price target is around $30.
Right. The stock is trading at 46, and the so-called experts are saying it's only worth 30. Why the disconnect?
It's a classic case of the market pricing in the future before the analysts update their spreadsheets. Analysts are conservative. They hate uncertainty.
They're modeling what they know, which is declining vaccine sales.
Exactly. The traders pushing this to 46 are betting that the $30 price target is already obsolete history. They're pricing in the oncology future now.
And the smart money is usually first. You mentioned they're scaling up the Marlboro manufacturing facility.
Yes, you don't spend hundreds of millions scaling up a factory for a product you don't believe in. And Merck, who knows the data better than anyone, is doubling down. That's a huge signal.
Okay, let's take off the rose-colored glasses. We need to look at the downside, because there's some very real risks here.
For sure.
Risk number one is that valuation disconnect we just talked about. If the hype dies down, there's a long way down from $46 to $30.
That's gravity. If the market suddenly agrees with the analysts again, you could lose 30% fast.
Then there's execution risk. This is a complex business model. It's not just shipping vials anymore.
No, it's a logistical nightmare. You're taking a patient sample, shipping it, sequencing it, making a custom vaccine for one person, and shipping it back.
The vein-to-vein time.
Exactly. Doing that at scale for thousands of patients is a massive operational hurdle. It's not just science, it's logistics.
And finally, they have to survive the gap years. 2 full years of cash burn until 2028. That $8 billion pile could shrink a lot faster if COVID or flu revenue dries up quicker than they expect.
That's the vaccine fatigue risk. People are tired of getting shots.
Yeah.
If the government contracts slow down, that burn rate goes up, and that fortress balance sheet starts looking a little less secure.
So a massive potential, but a treacherous path. What's the verdict? What are we watching for next?
We've got a busy calendar. First, Q4 earnings in late January or early February. They need to confirm that revenue number and reiterate guidance.
If they miss on guidance, the stock gets crushed.
Absolutely. Then, late 2026, we get the phase 3 data for the cancer vaccine. That is the big one. That's the binary event for FDA approval.
So putting it all together, the pivot, the cash, the chart, the risks, final score.
I'm giving it a bullish score of 8 out of 10.
An 8? That's pretty high for a company that's still burning cash.
It is, but here's the elevator pitch. They've successfully pivoted. The 49% risk reduction in melanoma is real data, not hype. It proves the platform works. And with $8 billion in cash, they have the runway to get to 2028.
The upside is just that big.
The upside of a $100 billion cancer market, I think, outweighs the risk of the next 2 years.
Okay, but here's my caveat. This is a multi-year hold.
Oh, absolutely.
This is not a quick flip. That overbought RSI makes it incredibly dangerous right now. But if your horizon is 2026 to 2028, the oncology upside justifies the risk.
I agree completely. It all comes down to one question. Is Moderna a vaccine company that got lucky? Or is it a technology platform that just happened to start with vaccines?
And the answer to that is your entire investment thesis. If it's just a vaccine company, it's overvalued. If it's a tech platform for biology, it might be cheap.
Precisely.
Well, that brings us to the end of today's analysis. We covered a lot of ground.
It's going to be a fascinating year to watch this play out.
Absolutely. As always, thank you for listening to Smart Wealth with Joshua.
Don't forget to subscribe so you catch the next daily analysis.
And please, if you found this useful, like and comment underneath. It really helps us out. We'll see you next time.